All right. Today we have my old friend Kieren Lubin-James, CEO of BlockApps. Their tagline is your Web3 marketplace for real-world assets. He is also co-chair of the technical steering committee of the Enterprise Ethereum Alliance. And today we're doing something a bit different. We're going to talk about Web3 technologies, blockchain, and all of that. As many of you listeners know, I'm a bit of a skeptic, although I've known Kieren from the early days of even before Ethereum launched, when I asked him to co-chair an O'Reilly blockchain one-day conference at Fort Mason. And ever since then, he's been one of my resources in this space. So for this podcast, we'll talk about some recent trends in Web3. And I will set the expectations by saying that we're not going to approach this as Web3 skeptics, obviously. So obviously, every question I ask Kieren, I could ask it, but it with a follow-up question along the lines of, but can't we use a database? So I'm not going to do that in this podcast. So what I will say is this space has been around for over a decade. Today, as we're talking, the price of Bitcoin is above $34,000. So I think it's fairly clear that as an asset class, it's here to stay, at least Bitcoin and Ethereum. But what's happened over the last year or two probably has set back the space as far as kind of maybe not enterprise, but consumer adoption for a little while. But as an asset class, I think we'll go into this interview by saying that asset class is here to stay. Consumer apps might be set back for a little while. So with that long-winded intro, Kieren, welcome to the Data Exchange podcast.
Pleasure to be here. Great to see you again.
All right. So we'll talk about some trends that I've been wanting to ask you about the space. So the first is on sustainability and energy efficiency. So it seems like there's a lot of progress in this area, at least on the Ethereum side. So give us a rundown on what's happening there.
Certainly. So, for a long time, the blockchain space has been wanting to get away from the mining model. Basically, what mining is, it's a way to force people to expend money, really, but in the form of energy to secure the network. And it kind of guarantees that the people who care about, say, Bitcoin, which is the biggest mining operation, have to put their money where their mouth is, so to speak. So the reasons behind it are technical, where Satoshi figured out, a means to ensure that there was kind of an incentive alignment between the people who are running the network and the users of it, so that the integrity of the history would be assured, basically. The unfortunate thing is that, it's sort of, given that you have to put in energy to secure Bitcoin, it turns out that the carbon footprint, for instance, of Bitcoin is quite large, right? There are different estimates. It's in some ways comparable to certain smaller countries or certain big industries or this or that. I don't have the numbers handy on me, but it's been kind of a sore point, a bit of a sticking point with people. There are some people out there who are hardline, it's got to be mining. That's the best mechanism. It's worth any, environmental cost. And there are others who want to, preserve basically all of the benefits of mining, but do it a different way. So the Ethereum folks, Vitalik was talking about this back in 2014, very early on, that, they would launch with mining because it was well understood. Proof of stake, a little less battle tested. Proof of stake is one of the consensus algorithms, which mining is also a consensus algorithm, that is much less energy intensive, and always set out to transition to proof of stake as part of its sort of big technical roadmap. That did actually happen a year ago, thereabouts. I remember talking about it in Climate Week last year, so it must have been just a little bit more than a week ago. Big milestone. I think it, 99% plus reduction of the carbon footprint and energy intensity of Ethereum, maybe more. So, there's always this trade-off between redundancy. So for a blockchain, it's basically a database with a ledger of entries transferring value from one person to another. And you want that database replicated so that many different parties can have a backup of it and kind of authenticate the full history. At the same time, you don't want to go so crazy with the inefficiency. If things are billion times replicated, that's maybe more redundancy than you need. So there's this trade-off between sort of security and how energy inefficient you want to be. And mining, is much worse than just replication. You're burning compute for no reason. So it's a big stride. I think there's more there potentially, but there is sort of an intrinsic trade-off between like how many people are participating and sort of how much wasted, in quotes, energy there is. A lot of more of the new chains seem to be proof of stake or proof of stake like than proof of work. And it's also just the UX is better. So Bitcoin targeted a block time at 10 minutes. What that means in detail is not that important, but it means that you're waiting for a while for your transaction to confirm. So if I send Ben, a couple Bitcoin, I'm feeling exceptionally generous. If I had a couple Bitcoin to send, he's waiting a minimum of 10 minutes, really more like an hour, to really be sure that the funds have arrived. Ethereum made it much faster, and the proof of stake chains tend to be faster than the proof of work chain. So you're looking at a couple seconds now to confirm a transaction. And so that's a benefit of the new model as well.
So a couple of follow-up questions. One is, as far as deployment of proof of stake on Ethereum, is that it's fully deployed? It's basically what's being used today. And second follow-up question is, I take it that Bitcoin is still proof of work.
Correct. Bitcoin is still proof of work, probably will stay proof of work. I think somehow part of the value prop of Bitcoin is that, and it's a blessing and a curse, that it really tries never to change. There have been a couple forks. So interestingly, on Ethereum, there's a split between Ethereum and Ethereum Classic that happened back in 2016. I believe Ethereum Classic is still proof of work, and they set, a line in the sand and said it would always be proof of work. Ethereum, so I believe it is fully deployed. It was incremental for a while. I looked recently, and there are some smart contracts on Ethereum with huge balances that are sort of pooled assets for proof of stake. So I think it is fully ramped at this point, and the proof of work, which was sort of partially turned on for a while, has been entirely turned off. So, and yes, to your point, Bitcoin will probably stay like that forever, and we'll kind of just see over time whether that ends up being a big negative for Bitcoin or if it's just sort of tolerated in the long term. There are also a growing number of efforts to offset popular blockchains, some coordinated by the foundations themselves, like the Ethereum Foundation, some kind of external parties who care about those networks. So that's a growing area of interest too. And I would generally say, is given that we're active in sustainability, it's one of the few sectors that actually seems to assume blockchain infrastructure as integral and expected. It's kind of like a leapfrog phenomenon where most sectors have a lot of legacy built up. Sustainability is still kind of new and is just very accepting of blockchain tech at the center. And it's more an argument over which one, as opposed to whether to do it or not.
So just to confirm, so today, if I transact in Ethereum, it's going to be faster. There's no trade-off in terms of, security and veracity and all of this. And so now, what new possibilities and applications has this lower latency opened up, if that's the case?
Good question. So I would say, I think it's down. I haven't looked lately so on launch, it was sort of like a roughly 30-second block time. And I think they've trimmed that some. So let's say roughly 15 seconds to get in the first block. You still want to wait 5 or 10 before you know the thing really happened, because stuff can revert. And proof of stake is better for transaction finality typically than is proof of work. Proof of work, it's sort of probabilistic finality. I believe typically in a proof of stake, so we also use something close to proof of stake, but not quite. It's closer to just a classic practical Byzantine fault tolerance, which has complete finality. So once you get all the votes in, so proof of stake, I would analogize to a bunch of people voting on what the next thing is, where proof of work is still a bunch of people voting, but it's computers that are doing a really fast search, and whoever wins, they get to construct the next block, and then the others can choose to build off of it or not. Proof of stake, it's more like you're voting on a thing that's active, so to speak. And
Kieren, so with the proof of work, at some point you had these massive mining pools that became somewhat dominant. So does the proof of stake remove the possibility of a few, key players dominating?
Theoretically, it would. In practice, it doesn't. So there are minimums. I think it's 32 ETH to stake in the Ethereum world. There are typically going to be minimums just because there are practicalities with dealing with that many, voters, so to speak. And there are huge pools already. So if you don't have the 32 ETH, maybe you join the pool and you probabilistically get some return proportionate to how much of the pool you have. And some of the pools are absolutely giant. We've not solved the, 5 big pools controlling the network problem in either the Bitcoin or Ethereum case. But
proof of stake clearly has solved the energy consumption problem.
It has, yes, or at least it's really dramatically better. More than a 2 order of magnitude effect.
All right, my second question, which was a hot topic, probably in the order of a year and a half ago, NFTs. So what is the state of NFTs? First, give us a kind of a high level definition of what they are, and then what's happened to them since they became so popular. Because for us who don't follow this space closely, the impression we get is the bubble burst and somehow no one is thinking about NFTs anymore.
Yeah. Okay, so NFT stands for non-fungible token. Kind of a terrible acronym. Crypto space loves acronyms. ICOs, NFTs, AMMs,
DAO.
Really what an NFT is, non-fungible just means it represents something unique. So like US dollars, they're basically fungible. They actually have serial numbers, so maybe they're not completely fungible, but one is the same as the next. An NFT is meant to represent something unique. So it's, a JPEG of an ape. It's a JPEG of an X. I think of them like titles, actually. Really, it's so if you own one, you would have a picture of the thing, and then under it, it would kind of say, Ben Lorica.
So why, Kieren, in the early evolution of NFTs, why were they so associated with digital items instead of, because non-fungible items, as you point out, could be physical, right?
Yeah, I think it's because it was simple to understand and execute. So, if it was a motor vehicle title, there's a registry for that already. JPEGs did not have a registry that was well understood and useful for, say, licensing purposes or this or that. And it was just easy to jump, the infrastructure because there was kind of nothing in place. And it's simple too, right? I think early on, people had the idea, there were some early projects for, say, music licensing and the distribution of royalties. Some people did, in the very early days, look at properties and all that sort of thing, where there are big legacy incumbents in the way. And what they did was make it simple. Here's a picture, here's your name, you own it, and very tradable, and the title was secure. So I think that's kind of why it took off so quickly. It really took me by surprise. It's not what we were doing at the time and still do were much more real asset NFTs, so representing the physical motion of goods in the supply chain. There was an NFT, right? The asset changed hands across businesses. We kind of encompassed it in a data container. who's, got updated each time something happened to the asset. But we didn't market it as an independent thing. It was like, we're focused on creating traceability. And I think the simplicity plus the fact that you weren't contending with much of the legacy made the JPEGs and, really popular. And then people got good at generative stuff. So if you want to crank up your sales as an artist, maybe instead of one JPEG that you lovingly create, make a computer program so you can make 1,000, 10,000 JPEGs, and they're all unique, but in the same collection. And that was just a cool new medium for people. And there was generative music, etc. So I think it was excitement. There was something to do with a whole lot of crypto wealth that was sitting and looking for places to go, especially. So that's kind of maybe the connection with the bubble. A lot of newly wealthy looking to, do things that wealthy people have always done, buy art, diversify, etc. And so it's kind of a perfect storm of timing. Good, simple, understandable use case, lots of new buyers, no legacy to deal with. And so they really popped. And I think the reason, so you've definitely seen a crash since then. It's sort of people kind of realized, yeah, they're just JPEGs,
And then so what's happened since? So what's happening now in NFTs, broadly speaking?
So I would say I think the next phase rhymes with the first phase. You are seeing big corporates be pretty successful issuing NFTs. So where it's something that's unique still and has a recognized brand behind it, it seems to work well. I know Nike's done like 9 figures of revenue on its NFTs. The Starbucks sort of.
So these are NFTs to physical or digital items?
I think they're pure digital with Nike. I've not looked deeply into it.
Okay.
Starbucks has tied the loyalty into its app, and that's done a lot of sales. So I think, super fans of big brands will still buy the NFTs. And it's just that the bar for the quality and scarcity of the NFT got higher, right? I would also mention,
and to clarify, Kieren, so the people who are participating in this NFT economy with, let's say, Starbucks or Nike, do they know it's NFTs?
I think Starbucks is not obvious in the app.
So so these are crypto savvy people?
I don't think for either of those they are, although the people, like I know a couple people who have 250 NFT JPEGs or more. It's definitely a power law industry where you've got super traders who are crypto native who have a ton of them, right? And then the long tail are probably using like a Web 2 type interface, again, like the Starbucks app, and then may not know or not care too much that it's blockchain based. But yeah, so I think just the quality bar has gone up as the initial excitement has gone, and probably it's just the power law, right? So the popular artists are probably still doing at least okay with NFT launches, and then a whole lot has been eliminated because the initial exuberance is gone.
So what's your take on where does NFT go from here?
Good question. I think, and a lot of stuff we work on, some of it's fungible, some of it's not fungible, is still really at a technical level in NFT. I think they just get realer. Real being backing something, a real asset, perhaps. Eventually, things like car and vehicle titles, though those are tough because there are, state-sponsored registries for those. But also just the more, there'd be more emphasis on the issuer of the NFT already being a credible or popular presence already. Not to be political, I believe this wasn't fake news. I saw Donald Trump issued a whole lot of NFTs and raised at least 8 figures of proceeds. They're very funny. He's got like a Superman thing going on. I don't think that market goes away. I think it's, it kind of merges with the collectible market, and more, just real property as well starts to increasingly get represented as NFTs as we kind of chop away the barriers to doing so. I think.
Have you heard of this phrase? I just came across this phrase, utility NFTs.
I don't quite know.
So these are basically these are NFTs that have utility, subscriptions,
Okay,
assets,
yeah. I
to-
mean,
access to events.
okay, so
Yeah.
we do a fair amount of that. So we're helping power some like membership clubs, for instance. And so I suppose
So,
an
how,
owner.
so explain to us why you need an NFT.
I think it's when you want transferability. So like I'm in Miami right now. Miami is replete with member clubs. The people here are really trying to get you to pay some big one-time fee and then some annual subscription to like go eat at their restaurant or this or that or play at their golf course, etc. And it's existing demand. And in some cases, it might be easier to recruit members if you could let them get out of their membership. So you could create a transfer mechanism for memberships without blockchains, but it's hard to bootstrap a liquid market for them, whereas it's become the expectation for NFTs. So you can buy in, so a project we didn't power, like Links DAO is one of these. Links DAO created a Links, like LINKS, a membership in effect to a golf course. And you still have to pay to go to the golf course, but your membership sort of allows you to like activate for this year or get a discount, et cetera. And they use the proceeds that they raise is maybe like $250,000 to actually go buy a golf course, which is kind of amazing, So I think it's the combination of the security of the title, it being a kind of an interesting thing on the other side, and the fact that you can get out of it makes it attractive to the members, and then lets you, do some sort of interesting action at scale that would have been harder to do otherwise. I believe also the members kind of work together to source the golf course to buy. Like one of them proposed it, and then it got bubbled up to the top. Like the team behind it, I think, didn't themselves find the golf course. So it's actually kind of community governed in a way. And yes, could you do all of this without the technology? Maybe. Be less convenient. The liquidity is the hardest thing. Like, can you find someone who's going to buy this membership? There's a bunch of crypto people who would buy the membership. It's hard to transfer it otherwise. But yeah, so that's one with real utility. So I think I can't talk too much in the way of details, but we've got a couple like that we are ourselves powering that are starting to roll out of a membership nature. And yeah, so we've got some other ones like we have some shoes for sale on the system, and some other players do this as well, where you can buy the NFT that you can redeem for the shoe, but you don't have to take possession of the shoe. Often you would if you just, if you want to use them, then you would just have us ship them to you. If you didn't, if you're a collector, you've already got 30 pairs in your house, you want to buy another 5 pairs, have them stored elsewhere, maybe you just need the title and you could trade the title away, or you could redeem it later to pick up the shoes. So these are some good utility use cases.
I think the key, as you point out, is the liquidity, and just the fact that you have a standing population of people who are not only able to buy and sell, but they are enthusiastic about buying and selling.
They're enthusiastic, yeah. They're crypto people. I mean, there's a mix. There's lots of speculators, gamblers, but they're pretty positive. Like, they're willing to support things. Anything that's kind of like exciting and new, they'll quite often back with their dollars. And so, that's a great thing about the space.
All right. So my next question is a bit broad. It's about a vertical, right? So I started out this podcast by saying, that this space, at least on the consumer side, may have been set back a few years. So, of course, when we talk about crypto, in general, the space that it seemed to hold a lot of promises is financial services, FinTech, right? So, broadly speaking, so two-part question. One, what's going on in terms of FinTech applications? And two, has Wall Street soured a little bit on crypto given the crash and what happened at FTX? So two questions. So first of all, broadly speaking, what's happening in terms of financial services and FinTech? And then two, what do the institutional investors like in Wall Street think about this space now?
Yeah, good question. Okay, so on the first side, I think there was the thing that everyone hoped would happen, and there's the thing that has happened. So what people hoped would happen, and we worked on lots of use cases like this and still do work on some, was that blockchain would be the settlement infrastructure for everything. So you've got folks like the DTCC, which basically is a big ledger that has a bunch of securities that say, all right, Kieren owns these 5 shares of Apple stock. And, obviously it's held through some brokerage financial institution. And that when I sell those, it gets sold to someone else. My financial institution tells the DTCC to update the ledger. They do it, everything confirms. And that's how a lot of the world's wealth is held right now. And the hope was, okay, it's just a big ledger that records transactions and account balances. Like, why not just transfer all securities with the blockchain? Or do some subset thereof that's less automated. Trade finance, popular blockchain use case, bunch of companies going after it. Very document heavy. If there were one consolidating ledger that, made clear just what was going on in a complex shipping process that banks have to underwrite, then it would be way smoother, just much less manually intensive. They'd be able to, drop headcount, reallocate to other places, et cetera. And I think those kind of back end, bottom line oriented use cases have been just a tough sell. And they've been really hard to get players to coordinate on doing those, because you need a standardization of infrastructure to make that happen. And it's just been a challenge, right? And so there was a lot of early motion. I think the pandemic was the big thing that really slowed that down. I think these folks could have stayed committed to this path and created a lot of value. Some of the incumbents don't want the change. Some of them actually really do. It's a big benefit to them, but it wasn't such a burning problem that they had to go and fix it, right? So what I do see happening is motion towards actually top line oriented use cases. So like Franklin Templeton fairly famously has tokenized a bunch of treasuries, I believe, and it's like getting into the billions. Another just kind of classic use case, right? Stablecoins, right? Stablecoins are financial institutions tokenizing an asset that everyone wants, US dollars, gold in some cases, et cetera.
No. This is Luna and Do Juan, right?
Well, that too. Algorithmic ones, would generally advise against, most cases. But so I think where you're going to see the financial institutions in first are in the top line use cases. So where can they make money? They can make money by taking in deposits, basically. So the stable coins do that. There's presumably on the back end yields that they throw off, and
this is still a thing, stable coins.
Yeah, I mean, USDC is still really big. That's circles. Let me see what the market cap of USDC is right now. It's in the, hold on, taking a look, market cap. It looks like there's 25 billion of USDC out there. I think it's one of the biggest ones. So there's lots of dollars that are living on blockchains. They're actually in a bank account somewhere, but the blockchain, it's sort of like Zelle, or the blockchain can trade them faster. And then when you redeem, you go back to the legacy system, basically. And that's generating revenue for somebody, right? Similarly, the treasuries that Franklin Templeton tokenized, I'm sure there's a management fee in there or something. And they've made, I think, a close to $1 billion of those available on public blockchain. So I think what you're going to see actually is people focus on, maybe incremental is the wrong word, but use cases where they can see a pretty quick path to revenue that's somewhat substantial. And then they'll backfill those more transformational kind of back-end infrastructure focused use cases as they get more comfortable with the tech. Also, everybody's offering their institutional investors some amount of access to crypto. I think, I forget what, so did you see where the BlackRock news shook out? There was an ETF, then there wasn't, but I think there still is one. And I think that's responsible for some of the price pop. This has been in the last couple of weeks. It's been busy. So I think basically you're going to see big institutional capital inflows still. Bitcoin and ETH look very resilient. We couldn't kill it with a really big high profile federal court case or a bunch of high profile bankruptcies. And so I think it's just where's the revenue and how long does it take?
So the examples you named, like the treasury and stable coins, so who are the people who are participating in these markets?
So crypto natives and friendlies want access to the hard assets on blockchain.
Okay. So it's not mainstream people.
Not yet, I would say. And then the institutions want to make revenue on providing that access in the short run. They also want to make revenue on providing their institutional clients access. So you're seeing more like the traditional financial institutions are starting to be the bridge into crypto as opposed to converting their infrastructure to crypto. But I think they'll meld together slowly over time.
So maybe two years ago, you had a lot more news coming out of Wall Street, initiatives and things like this, right? So even hedge funds who are trading on FTX and things like this. So what's happened since then?
So we're not so deep in the trading side, and I'm not quite so sure. Volumes are just clearly down across the board. Kind of interest rates went up, prices went down, volumes correspondingly went down. I don't think it's dead. I expect they're still doing it and they're just kind of quieter about it. Maybe some folks are accumulating with the relatively, we had a period where like Bitcoin peaked at 60-ish thousand, fell to 15-ish thousand, and is back up at 34. So someone's buying it along the way. And it's probably a mix of institutions and the more retail audience. But I don't really know. I think they're quiet about it for whatever reason.
What about the other fintech use cases that were touted at the height of the bubble? Things like remittance.
Remittance is real. When I speak to people who, even in the US, right, we've got a lot of users, but they're mostly speculating. When I speak to people who are really reliant on crypto in the day-to-day, it's in call them emerging markets where you want access to some kind of stable-ish currency, and you may be a big I guess like sort of like labor export market to the US. I think the Philippines is typically one of the biggest, where really large capital flows are going from the US back to the Philippines. Used to be, Western Union took like a 10 to 20% fee on every dollar that went through there. So even taking the currency risk on Bitcoin, transferring it in, maybe there's a 1% fee on that, and transferring it out, it's just so much lower, and there aren't good rails to make it happen otherwise. That's real, right? I think there's been really high uptake.
So are these traditional companies who are offering the services like Western Union, or is this a new crop of people just sending money to each other on MetaMask?
Some of it is full on decentralized. Some of it is like the local popular exchange. So, for instance, I'm aware, just sticking with the Philippines, I believe like Binance is not actually registered there, but had roughly 10 to 20% of the population as users on Binance. So I assume, you send the money to the whatever address is associated with the person's Binance account, and then they convert it to local currency on that side. So yeah, I think it's the new players primarily. I don't believe it's going to be the traditional financial institutions.
And what's your impression, Kieren, of the regulatory framework and environment for all of these things that, if you do that, let's say if I send you money in the US, there's all sorts of probably rules that we have to adhere to, right?
Yeah, I would say it is confusing and still early. It's not been enough to kill the industry in the US, but it's been unfriendly. And I think probably what's needed is, I think that the regulators are actually more understanding of the technology. Well, let me raise that remark. I think law enforcement actually understands the tech pretty well. They've been watching it closely. There are folks like Chainalysis out there helping you kind of trace where the transactions go. Our friend Lauren with breadcrumbs. And so when there are these high-profile busts, if you will, law enforcement has actually been okay at figuring out where the funds go. Regulation-wise, I think there's still just a little bit too much of an effort to retrofit the existing, and I'm speaking about the US regulatory regime, onto the system. And maybe it's actively hostile and trying to eliminate crypto, and maybe it's incidental. I don't really know the answer to that. But for instance, like personally, I don't care too much whether crypto tokens are treated as securities or commodities. The only reason I care is that it's sort of the compliance burden with securities tends to be much higher and do some things that people would argue are antithetical to the technology. Like there are cases where you might not want to, identify absolutely everybody on the system, and often that's required for securities and maybe not necessarily for commodities. If you're holding some gold, you're just holding some gold. And so there are incidental benefits of the technology being treated as a commodity versus a security. But I think what's being lost is what we want to prevent are more FTXs. Like, we don't want the consumer to be harmed. We don't want grandmas living their life savings. We don't want hucksters selling people crappy investments, pocketing the money and running. But like somehow we have to make that the goal. And I think what's being, dragged in are these like sort of jurisdictional conflicts. Like, is it the CFTC? Is it the SEC? Is it Treasury? And the rules are sort of totally unclear as a consequence, because it's not clear whose jurisdiction it falls under. It could be both. There are all of those in different cases. And so it's not ready yet. That said, I think, we talked about the optimism of crypto people, right? I think they're just going to keep moving forward, and most are not the type that actually is actively hostile to the regulators. I think there's certainly a big subcontingent that are, but that they would just prefer clarity that doesn't have rules that sort of regulate the technology out of existence, basically. So if we could get to that, that would be great. And again, I think no one wants to see, grandma injured, and that's really what the regulators care about. But there's this big question of the how.
Right. All right. So the other vertical that I kind of suddenly started noticing is this notion of using some of these technologies for the next generation social websites. So is this a thing? Is this my imagination, or are there actual attempts along these lines?
It is a thing. Okay, so
and what's the, explain to us broadly what's the rationale?
I think there's kind of two sides to it. So and I'm fairly far from this part of the industry, so I'm speaking as only slightly more of an expert than you are, let's say. But there's, I think, rightfully the perception that our social media platforms are sort of too powerful, too influential, centralized, too easy for like some small group of people between the executives and the government to control, turn a couple dials, disappear people, or augment certain messages. So, I think we even saw way back with like the Arab Spring, Twitter, I believe, played quite an integral role in helping that happen and coordinate, et cetera. And your opinion on that, it may not even matter. The point being, these things are powerful now. And so people are skeptical. They can influence elections. Google, I think, has stated that it could probably move an election 3 or 4 points if it wanted to. I think they've said that publicly. So there's this general skepticism of the power of these platforms, and some of it's structural. Like what crypto people would want is them to publish the source code, publish how it works. And so more of a community could drive how the data is stored, how content is targeted to people, make sure that data doesn't just disappear, similarly, or unless the end user wants it to. Similarly, just have more of a say in how the platform runs. As a user of these systems, you're creating content often, and sometimes you're appropriately compensated for that content. Sometimes, and maybe the big referral center for your e-commerce business or what have you. Sometimes you're not, but it's definitely easy for the platform to just shut you off one day, and so folks do not want that to be the current state of affairs. Another aspect of it is, and I guess it's related to the compensation point, people are starting to want to kind of make, I hate to say bets, but sort of bets on individuals. If you've seen FinTech, I haven't actually tried it, but it's really popular, and it seems that it allows you to just, it's as if you were like able to buy like shares in Kieren now and kind of follow what I'm doing and see if social sentiment causes those shares to go up over time, which, by the way, I think that idea is a good idea. Like, I think, there's a lot we could do to make markets out of human potential that we don't do to date. Who knows if it fits in the current compliance structure? And I think it's early. It's not just like a huge spike in users. I think it has dropped off a little bit, and we'll see if it's sustaining the FinTech revolution. But that's the other side. Like, could, in addition to the data being more user-centric and having more control over the platform itself, could you, in a more open way, kind of start to directly monetize internet personalities in a way that's kind of more transferable across platforms and has liquid markets, around it? I think both of these ideas are good and cool. The latter actually may be easier to implement technically, right? So there have been many folks who are trying to, say, store files on blockchains plus distributed decentralized data stores. And that would be a way to make sure that your images never disappear if you upload them onto Instagram, right? So you're going to always have access because there's this distributed network that you can join that's incentivized to store them at any time. Whereas Instagram could disappear you any day it likes.
So then, do you think that this for any of these to take off, do you need people? So either people become more crypto aware, crypto savvy, or crypto tools become easier, or neither. Maybe you can obfuscate the use of blockchain and crypto.
I think the UX has to get better, and mostly we're going to get the next users by hiding the crypto backend. But there should be a good reason, if needed, to have recourse to the crypto side of things, like it really can't delete the data unless you allow it to, that sort of thing. And people might get used to that feature and then demand it in the future. Also, just portability of data across platforms has been something that crypto people have been trying for a while. So like LinkedIn hates it when I post links to other platforms on it. And so one worries eventually that, you can't, and LinkedIn is actually good on this. It'll let you export your contact list and all that sort of thing. You worry that your data isn't really yours and you can't move it somewhere else. The hope is that would get really good. And then all new platforms would start sort of writing to the decentralized version of Kieren that has data aggregated across all platforms instead of siloing it each in their platform for stickiness. That maybe will happen. I don't know. If users demanded it and it worked well, it would happen. It's going to be very hard, obviously. So
this reminds me. So there's a community called the Indie Web community, where these people have been working on things for federating the web for a long time, right? So things like Mastodon came out of this community, but now they've revived this concept that they've had for years called, I think, Posse, the POSSE. It's basically post once, spread everywhere. So the idea is you'll have a blog, Kieren, you post it there, and then it just posts it everywhere, like to LinkedIn, to Twitter. So obviously that's possible, but there's a lot of details to be worked out in terms of, what if you update your blog and... so but the spread everywhere is actually more than what we think. Like if you publish a blog in the Posse sense, right? So it not only will post it on a social media site, but it'll kind of try to post it in a way like a thread, So it's
Yeah.
not like, here's a link. Kieren just posted a blog post, here's the link. No, it's going to try to kind of literally post it as a thread in this social media website. So, which, you might be able to do once, but like I said, if you update your blog post, then it's just a mess. So there's a lot of details that people haven't worked out, but yeah, it's just interesting that it seems similar to what you're saying. Yeah.
We used to use Buffer, which was like that. We'd make one post and it would post on all social media. But yeah, to your point, for longer form content, Twitter's got rules, the other platforms don't, and they may not work super well with it. I hope it happens, I think. But the big social media companies are well resourced and probably don't want it to happen. They want to win individually, but it may.
So the other thing I wanted to ask you is there any kind of cooperation or overlap or intersection right now between AI and blockchain and crypto that seem interesting to you? I mean, obviously you mentioned something about NFTs and generative AI, so that's one thing. So anything else beyond that?
It's pretty early for it, I would say. So we are users of AI, but not makers of it at this time. I think it's useful for, the mundane stuff like writing job descriptions. It can help me, get it out quickly, and then I'm in the editor seat more than the writer seat, for instance.
One of the things that I've been worried about, which, maybe the folks in the blockchain and crypto community might consider thinking about as well, as right now, right? So it's clear that people are going to do fine tuning and custom models, and a lot of that presupposes that you have access to an open source model that's decent and has the right license. But right now, honestly, if you look at it carefully, there's only a few suppliers of these open source models that are decent. Meta is the main one, and maybe Mistral, the new startup in France. So what if these startups in the next release of their open source models change the license? You can't use it for commercial purposes. So we don't have a supply of open source base models, is what I'm saying.
It's an interesting point. There's always the worry that happens. It always does happen after they go public. MongoDB, all of these made an even more restrictive license. They were already restrictive but open,
so a lot of our efforts presuppose that we have the steady supply of base models that are decent, right? So
usually there's a fixed version that you can hold on to, and when they bump the version, you lose access. But I think there was I don't know if it ever got popular.
Yeah, no, but what if the bump is so pronounced?
True.
Right, so then you're behind, basically, right? So
you're behind, but I guess it's like someone has to eat the cost of governing the model in the long run, and
exactly,
so you get as far as you can go.
So are there governance lessons from the blockchain community that will allow kind of the rise of pre-trained base models that are much more on communitarian?
I have two related comments on this. So on the one hand, I've heard a bunch of projects where people in their concept stage, but they're trying to figure out how to very directly incentivize the training of these models with sometimes extra feedback with token issuance and some review mechanisms and this sort of thing. So you add something to a model, maybe you add ground truth data to it, you get paid for that if the community gives you a thumbs up. So one of the lessons is that if there's money in it, people will keep doing it, and
so that's a good, that might be a good point of intersection, because the blockchain and crypto community have the infrastructure for this kind of crypto rewards mechanism, right?
Yeah, exactly. So I've seen some of that, and again, very early, tricky to actually execute well, but it's a thought, right? This goes back to even mining. The reason Bitcoin continues to exist is people get paid to make sure the next block comes out, right? So and that's hardwired in. to the protocol. I think the other is just sort of, more broadly, bootstrapping a big community and keeping them engaged is something that blockchain people have gotten good at. And I think there's a clear, enemy in mind here. Like, let's make sure, Facebook keeps it open. For the more proprietary models, let's make a better model than those. So I think open source software in general has both, taken over certain aspects of, it's the server software is pretty much all Linux based, et cetera. And you both needed a big community and a couple big businesses behind it. And so if the big community gets the thing far enough, maybe the businesses will sort of be forced to keep it open. It's a kind of a combination of licensing, but sentiment, if you can get a distributed group of people to do more work, in a sense, like the Linux kernel, maybe, then one company would want to take on itself, then there's less of an argument. Whereas like a MongoDB or something like that, where the licensing change happens, really it's pushed by one company. It's not that many. There are lots of third-party contributors, but they're not working full-time. Whereas like a Linux, there are lots of full-time people at IBM assigned to it, at Intel, at wherever. And so it couldn't really be consumed by one organization that could turn it all off. I guess decentralization is the lesson. Again, so we'll see. I think we are, again, excited to use the technology ourselves. We're not, making top line use of it, but, it's helping the programmers programs, helping people write, copy, all that sort of thing. So we're just trying to stay close to it as end users and kind of see if it leads us to something interesting to kind of incorporate in the product.
So what are 1 to 2 things that are happening right now in crypto, blockchain, Web3, happening already right now that those of us who don't follow the space are picking up on, or the mainstream media isn't picking up on?
Okay, so I think they're picking up on this some, but it's a bigger movement than people expect. Just big move to real assets. People have realized blockchains are good, not just at native tokens like Bitcoin and Ether, but creating lots of different asset types, and that most of them are not valuable at all, right? We saw this kind of spectacularly. Part of the FTX thing, they had their balance sheet denominated in their own token, FTT, which was okay when it was really valuable. When interest rates went up, when confidence went down, that plummeted, and that helped to start the cascade that took the whole thing down, right? So just the availability of quality assets will do a whole lot to making the systems sort of robust as, independent financial systems. It's happening in a big way. We're working on it. But you've also got like the Templetons I mentioned, and there's big demand, like I said, kind of from crypto natives, crypto friendlies who want access to harder assets, and then also to, institutions who want to buy them, but also on the other side want to provide that access as well. I think that's going to be the story for the next wave. A little bit in reaction to this past wave, like it blew up in a big way, and we're all still here, thankfully. We're not all of us, lots of us are gone, but those who are still here are building hard. And it's probably the big thing to make it practical, right? Like it may have just been, their blockchain has been proved to be really useful for bootstrapping liquidity, getting a lot of people to work on something together, ensuring that things remain kind of
and again
they're missing.
And again, not to split hairs, maybe you can implement these things without blockchain, but as we've been pointing out, the advantage of blockchain is you have this army of people who are enthusiastic, ready to participate, who are already able to participate because for whatever reason, they have wallets, they have currencies and things like that, right? So
yeah, it's become super interoperable, and composable is a word blockchain people like to use. So, the whole has become much more than the sum of the parts at this point.
Okay, so that's one thing, hard assets. Any other things?
Think about that. Okay, what are other
that are happening right now that we are not aware of on the outside?
Let me think about this for a minute. I think it's just that, okay, so the VC market in general has collapsed. The blockchain VC market's collapsed more. The people who chase the tech trends are gone. They're working on AI or something else.
Oh yeah. There's a lot of them here. That last year were Web3, now AI, right? So yeah.
And maybe it's a good way to combine the VC pitch. Although maybe you have to drop Web3 right now. But that people are working hard and making good stuff. And this kind of happened so it's a cyclical industry. Like the first big crash was Mt. Gox. Then there's the ICO boom and bust. Then we've had another one. It's like oil and gas in this way. It's just prices are high. There's a lot of exuberance. Prices are low. It right sizes. That's when they do the cuts, the layoffs, all that sort of thing. I think we're starting to be, back in warmer times. I wouldn't say there's going to be a bull run or anything. And the big next wave of companies are working hard right now. And this happened very much, the big companies of last cycle tended to raise a whole lot of money in the ICO boom, were heads down for a while, and then got extremely popular overnight as liquidity returned. Binance is a classic example, FTX2, and for better or for worse, right? I think it'll happen again, and it's just people are going to be smarter this time and avoiding at least some of the pitfalls of last time.
Yeah, I think at the height of COVID, there was a lot of trading of crypto assets as well. And that seems to be a unique event that may not happen again. So whatever this next upward trend in the cycle might be on safer foundation.
I hope it's not as fast, actually, next time. You want the liquidity to return, but when it goes so fast, people get too excited and throw too much of their personal wealth at it, and too many scammers come in. If it's a little more measured this time, that would be better. Yeah. And with that, thank you, Kieren. Absolutely. Thanks, Ben. Pleasure.